Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
On cue here, Ian Lingen publishes BMO Capital Markets. We're double-barreled. We got Ian Lingen publishing and Dan Skelly just darkened the door. It doesn't get better than this. Let me quote exactly for Global Wall Street, Mr. Lingen. With this backdrop, we struggle with the notion of wanting to aggressively fade the rally. That's price up, yield down. Don't go against that. On the other hand, is three-handle tens approach. The 4.00 to 4.02% zone will be difficult to breach solely based on sentiment brought in from the holiday weekend. Ian Lingen there moments ago. We are so advantaged that Dan Skelly's here off of that statement from Bank of Montreal. Mr. Skelly is with Morgan Stanley Wealth Management. Is it a new bond regime? I'm looking at the Bloomberg and it's saying there's a trend in place. Do you buy it?
Good morning, Tom. It does feel like people are risk off at the moment, obviously. You've got this, on the one hand, dissonance in the fact that people want to play global reflation, small caps, international. And on the other hand, you're seeing just bond yields lower in terms of, I think, further fears of further concern around the AI trade within the U.S.
You're linking the AI trade dynamics over to price up, yield down.
You can't do it with the economic data, whether it be the surprise index at multi-month highs, whether it be the jobs data as of the last week or two. So you can't link it that way.
Dan, I mean, nobody does tech research better than the Morgan Stanley complex. You guys have been leaders on that for decades here. What do you guys make of this fade software, just broadly defined? I mean, software is a story that just works for everybody all the time. Now it's really under some risk here.
Sure, and thank you, Paul. Appreciate that kudos. So, number one, I think it's one of these many examples of dissonance at the moment. On the one hand, the market is fearful over AI spending. On the other hand, the market's saying software is going to be disrupted. So I can't explain that one in terms of efficacy versus disruption. And look, I would say not all software, not to be that completely out of consensus, but not all software is created equal. When I look at the varying types of software, some of these companies are actually partnered with the AI model makers today.
Right.
You know, it's funny, we were talking about software and just tech research, and you think Mary Meeker, she was in the news again this weekend, Mary Meeker. She won the AT&T Pebble Beach Pro-Am.
Wow.
No way. Go away. What did she do? Hand her PowerPoint?
I don't know.
Her PowerPoint?
I saw her in the news.
Remember her PowerPoint?
Oh,
and
yeah.
you had to sit there in a bar with Alexis, you'd sit at a bar in Midtown Manhattan with the beverages of your choice. Beverages. Because it'd be, what, Dan? It'd be 64 pages. And the problem with Mary, every page had value.
Yep. That was a problem.
You know, it was
good stuff.
64 was the intro.
Yes.
Yeah.
Yes, exactly. So what are we doing here? Broadly defined with equities here, 2025, excellent returns in the U.S., even better returns outside of the U.S. What's the setup here for 2026?
So number one, we're saying to stick with the international trade, right? So on the one hand, whereas the AI-centric optimism has now ceded to concern, that's obviously benefiting international, number one. Number two, you've got policy and fiscal tailwinds helping Japan, helping Latin America, helping arguably Europe in some degree with this defense spending and a revamping of the military-industrial complex there. Number two, we're telling folks don't abandon the large cap quality adopters in the U.S. I think the biggest dissonance I've observed over the last month, and we've known software is going to be disrupted for the last 2 years, so that's not the big surprise. It's that every other sector of the market has seemingly been taken out to the disruption woodshed. And a lot of these, by the way, were the names that were the biggest adopters of AI previously. That's the big dissonance.
Earnings were, 3/4 of the way through earnings. It seems pretty solid out there. Has earnings been solid enough for this market going forward?
Not at the moment.
Yeah.
I think the market is losing sight of, we talked about the macroeconomic data earlier, pretty solid in and above itself. And earnings is broadening out. I think the key trend at the moment is that you're seeing Russell 3000 median earnings growth of around 11%. And that's up from, call it, low single digits the last year or so.
I mean, I look at the Google bond deal the other day. Lisa Shallot loaded the boat for Morgan Stanley on a 100-year British piece. But I'm sitting there this week and going, okay, Microsoft's in the tank, down a couple dollars this morning as well. It's closed at 401. It's trading now 399. Okay, Dan Skelly, fine. But can't they and others in one Bloomberg headline change the zeitgeist by saying we're going to do a ginormous bond deal off Dan Skelly's desk at Morgan Stanley?
Well, we'd welcome the partnership, no doubt. Listen, I think when you look at the majority of AI spend, it's still being funded from cash flow. On the margin, there is leverage coming into the system. But, Tom, as you know, many of the Mag 7 balance sheets are net cash balance sheets. They could afford to take on some leverage.
Am I right that they could do one? What do your tech people say? Can they do one tranche, two tranche, 30 billion here, 20 billion there, 16.5 billion
The demand is
there?
Off the charts, as you know. And so, we think there's
Am I nuts, Paul?
No, I'm with you.
We think there's some room to take on some leverage here. But look, at the end of the day, we think the market is efficiently and probably rightfully taking a pause on Mag 7 at the moment and the S&P because we've had this massive spending ramp up. We have alternatives for the first time in a decade. We have other markets with momentum. And we all know what momentum as a factor has meant for equities over the last several years. It has truly taken the baton from valuation. And so at the moment, momentum matters.
So does that lean outside of the U.S. versus U.S. here? Because, I mean, when you look at the European markets, they've always traded at a discount to the U.S. because they don't have that tech exposure that we have. Is that now the time for them to shine as they did last year?
Yeah, it's a fabulous point, Paul. And number one, that's true. It's the absence of a negative at the moment. Number two, it's real fundamental catalysts. So whether it be defense we talked about, in a post-Ukraine recovery effort, we might see a Marshall Plan type equivalent rebuilding infrastructure out there. And number three, when I look at fiscal policy, right, we've talked a lot about the U.S. fiscal and political situation. Look at what's going on with Japan post the elections. We now have a supermajority.
I point out Microsoft, they're out 35 years on their longest piece. I mean, I'm sorry. Morgan Stanley needs to bring a 100-year Microsoft.
Sure, they could do it.
6.XX%.
They know what they're doing over there.
So let's just squeeze one more question in here. Dan Skelly, to all the people listening across this nation, watching on YouTube, do you quote unquote go to cash here?
We would not, Tom. We would say stay invested, right? We've been telling folks to be diversified, right? And we've said this for over a year. Initially, a year ago, I commented Mag 7 would go from this monolith, everything up together, to more of a peloton, where there's more dispersion within the Mag 7. That's played out. And roughly 6 to 9 months ago, we started thinking about broadening out, whether that be value trades within the U.S., or whether that be internationally. So we think there's enough opportunities at the moment not to go to cash.
I thought you were talking for you and me that it was a Peloton trade because we were broadening out. We get a 3-day weekend report from surveillance Peloton correspondent Paul Sweeney. How many times are you on the beast this weekend?
Multiple times on the bike and the treadmill. Both full service.
This is getting into beach weight, right?
Oh, yeah, absolutely. Yeah,
Very
absolutely.
good.
It's just, we're there. We're there. I don't know where everybody else is.
It's just Dan Skelly, thank you so much.
Thanks
really important comments there from Morgan Stanley, head of market research and strategy, Morgan Stanley Wealth Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We start strong this morning. Holger Schmieding joins us with Berenberg Bank. Just fabulous on the transatlantic tensions of the moment. Holger, do you see a global disinflation? Is China messed up enough where they export price stability or price decline, which means bond prices up, yields down?
Well, on its own, this is exactly what China is, of course, doing. It is dumping the results of its industrial overcapacities on global markets. But there are other forces pointing the other way. Of course, the US tariffs are not yet fully reflected in U.S. consumer prices. There is some further upward pressure on U.S. consumer prices to come. Also, many raw materials are telling a very different story, namely that global inflation pressures will stay a little elevated or could rise over time. And longer term, simply labor shortages on both sides of the Atlantic and also longer term in China, labor shortages will probably mean in the end a rebound in wage pressures, perhaps not immediately, but say next year and thereafter. So I would not bet too much on global disinflation.
Holger, here in the U.S., we have a lot of economic data last week we received in terms of inflation data, labor market data. The data suggests that maybe the Fed can sit idly by and let this economy purr along. What do you think this United States Federal Reserve should be doing?
That's exactly what the Fed should be doing. There is no reason in the US to cut rates further. Rates are already fairly low, especially against the backdrop of a very expansionary fiscal policy. The US economy is clearly still expanding above its trend rate, which in our view is now 1.5%, the trend rate, but the current pace of growth is above 2%. And well, yes, the labor market does not require further central bank help for the time being, so the Fed should stay put. Our call remains that when the new Fed chair comes into office, the committee may grant him 125 basis point rate cut, but thereafter, probably that's it for the Fed in terms of cuts.
You're the first one to overtly mention that. I mean, this is a huge deal. Do you think within your reading of central bank history that when a new guy shows up, what do you call it in golf? Is it like a mulligan? Is that
you get a mulligan or breakfast ball.
Is Chairman Warsh get a mulligan, Holger Schmieding?
Well, that's possible. By the time he comes in, we may see that the labor market is not quite as strong as it was in the January data. You can always argue sort of about 25 basis points, yes or no. So to bet on, in our view, one further rate cut to come under the new president makes sense, but betting on more rate cuts to come in the US, as many in the market are doing, in our view is overdone. Simply, the US economy does not need a rate cut. And longer term, while the US economy will likely lose momentum next year, longer term inflationary pressures stemming from basically a lack of labor, including the immigration clampdown, should then see to it that there is no further reason for a cut.
Holger, almost a year ago, in response to the tariff issues, we saw European economy step up and really talk about spending more on infrastructure, spending more on defense. Have we actually seen those funds be committed?
Well, you use the right word. We are seeing those funds being committed. That is, we've seen a major surge, for instance, in German industrial orders late last year, a huge surge related largely to defense, similar things, and to some extent to infrastructure spending. We are seeing it in orders. We are not really seeing it yet in production. It takes time for companies to ramp up production, but the orders are coming in, and on a much smaller scale. Even countries such as Italy, France, and the UK are trying to raise their defense spending somewhat. Yes, there is a fiscal stimulus coming.
How do you frame Euro, Holger Schmieding? I mean, it gets away from your, I get that Berenberg Bank's acutely aware of the euro, but against the dollar, are we in for some boldness here of euro movement?
Well, probably not much in the near term. We have serious geopolitical tensions, which tend to be a bit dollar positive. We also do not expect the Fed to deliver as many rate cuts as others in the market think. So that's a bit of dollar positive. Having said all that, the European economy last year surprised a little to the upside. And there is scope again for the European economy this year to do a little better than last year. Not extremely well, but a little better. Also, there is this long run erosion of global trust in the US, its institutions and its currency, as we see with this switch of some emerging market central banks out of dollar assets into gold. So longer run, I think the dollar remains on the way down.
I mean, this is it for the week. We got to ask Holger about the Swiss franc.
Oh, boy.
I mean, the FT, Holger, writing up the Swiss franc, I think not once but twice this week. And I'm looking at the two charts, Euro Swiss and also dollar Swissy. And the bottom line here is there's some huge Swiss strength. What does that signal to our American audience?
Well, that signals a bit of a move to safe havens. And Switzerland is a safe haven, seen as very safe, but it's very, very small. A bit like gold, a small move into safe havens makes a huge difference to gold, makes a huge difference to the Swiss franc, but much less of a difference, say, to the US dollar.
Holger, thank you so much. Holger Schmieding with us with Berenberg. A brief. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Libby Cantrill joins us now, Managing Director, Head of Public Policy at PIMCO. My basic take, Libby, is everything's rushed. Like in February, we're living what would be a normal May or June before an election year. Am I right on that?
That is right. Yeah. Good morning, Tom. Yeah, I mean, you're absolutely right. This year is compressed just because, of course, the midterm elections. I think both the House and the Senate leaders are going to be eager for their members to go back to their districts and states to campaign in advance of November. So our expectation is, in many ways, this Congress probably will likely come to kind of its end, near July. Now, of course, they'll be back in session in September to hopefully fund the government once again for fiscal year 2027. But outside of that, we're not really expecting much legislation, beyond the August or the summer recess.
Libby, in one of your recent notes in your Washington Watch note, you have entitled, "Was 2025 peak Trump?" What do you mean by that?
Yeah, so in many ways, this is pretty consistent with other presidential cycles. The first year of an administration, particularly when the party in the White House controls both chambers of Congress, does see its sort of peak presidential power. Congress usually gives a wide berth to their president to sort of do what they want to do. The courts in this case of Trump have been sort of slow to catch up. So in 2025, like 2021 was for President Biden, like in some ways 2009 was for President Obama, we do believe that 2025 was peak Trump in that it was sort of his apex of presidential power. 2026, and we've already seen some signs of this at the end of 2025 and the beginning of this year, we think the constraints of both the Congress and the courts will bind this president more. And again, this is less of something sort of specific to President Trump, and it's much more sort of indicative of the general political cycle where, members of Congress in particular start pivoting to their own survival and pivot to midterms. And as a result, start pushing back on their president, even when it's the president of their own party.
Is the Senate at risk? I mean, can the Democrats win the Senate from where you sit, Libby?
I think if you had asked me several months ago, I would have said absolutely not. Now, it's still not our base case. We still think that the GOP will control the Senate, but there are some primaries that are going to be quite important. Texas, in particular, on March 3rd. Who wins that on the Republican and Democratic side? I think we'll sort of tell whether that state is actually in play. But as you know, Tom, right now Republicans control the Senate by 4 seats. Not only would Democrats have to defend seats in Georgia and Michigan, those are seats that they have right now that, of course, Trump won in those states, but they would have to win 4 of 6, pretty reddish, pinkish states, including North Carolina and Maine, but also Ohio, Texas, Iowa, Alaska. Again, they would have to have a perfect night. I think to take back the House, they would have to have a so-so night. But in order to take back the Senate, they would have to have a perfect night.
So, Libby, you mentioned the courts here. I guess we're still waiting on the Supreme Court's ruling on tariffs. Are you surprised that it's taken this long? And does that tip the hand to maybe how they may vote here?
Yeah, I'm gonna defer to the sort of the court experts, which I am not one of. I mean, I think, according to those experts, though, this timing doesn't seem, all that suspicious or all that much of a tell. I do think that that Roberts is likely trying to, if this verdict does go against the White House, probably trying to get as much of a majority on that opinion as possible. So that may, justify the delay or what have you, or explain the delay. But I think the bottom line here for markets and what we're telling our clients is that even if the court does rule against the White House, and again, just based on the oral arguments, it looks like at least in some form or fashion they may, that this White House still has many other tools that Congress has given them. Maybe not IEPA, which is the law that's in jeopardy here, but Section 122, Section 301, sort of this number soup of provisions. They can still impose their tariff agenda.
Libby, talked to Peter Navarro last week, and he was spirited, to say the least. We thank Mr. Dr. Navarro for his appearance, and I got him upset talking about how McKinley, late in his term before his tragic assassination, made what was called the Buffalo pivot. Are we in a slow motion Buffalo pivot right now as the president brings down tariffs?
Yeah, well, I think I think there's likely some sort of suggestion that, some folks in the White House do realize that, tariffs on things that the U.S. cannot produce, bananas and coffee, for instance, are, areas where maybe some tariff relief is necessary. There's, of course, some reports that there is, some tweaking of the steel and aluminum tariffs as well. Could we see a bit of a softening on tariffs? Sure, as sort of, again, realpolitik kind of sets in here in advance of the midterms. I think, though, however, Tom, to underestimate this president and his sincerity and conviction on tariffs is something the markets continue to do, and I think they continue to be on the wrong side of that.
Yeah, there's some wisdom.
This is an ideology, of course, he's had for decades. The president feels a sense of urgency to administer his trade agenda. And again, even if there is some sort of political expediency that sets in, I think our view is that the markets and the economy are still going to have to digest, tariff policy and trade policy risk as long as this president's in the White House.
Libby, affordability has become a big issue in this cycle of economic discussion here, and particularly one of the areas is housing and the lack of affordability in housing. And I know that the House is expected to pass the Housing for the 21st Century Act. What is this act, and does it have a chance to become law? And how are our leaders trying to make housing more affordable?
Yeah, so it does, and it did, and the House and the Senate have now passed their own sort of respective bills. This will now go into what's called a conference committee, which, as you guys know, is sort of the fancy way of basically saying that the House and the Senate will kind of hammer out the differences in that legislation, and then we'll have to go pass a unified bill. I do think this will be signed into law. This does, I think, show you that both sides of the aisle are quite worried about this issue, just politically speaking. Of course, housing affordability continues to be one of the big laments among voters on both sides of the aisle. The reality is, however, that at the federal level, there are just, few levers that policymakers can really pull that have a meaningful impact on supply. One thing that we do think that the White House has done and probably will continue to do that could help is for the GSEs to continue to buy mortgages. They've been doing that over the last few months. That has brought down mortgage rates, at least incrementally. We continue to expect them to do more of that.
But the key thing I heard there, Libby, is from here to eternity, you don't see any more legislation coming out of the Senate or the House signed by the president?
No, and sorry, I do. We do. I think the House will. I think that the president will sign this housing bill into law. But outside of that, and then again, a funding bill for fiscal year 2027, there just may not be very much. I think there's been some hope among market participants or some expectation that Congress may pass something in advance of the midterms that could boost the economy. We don't think that is the case. We don't think there will be this another reconciliation bill, no more tariff dividends or what have you, which Congress, of course, has to authorize. So, yeah, I think that's going to be, some cats and dogs, Tom, but nothing really significant from a market's perspective.
Libby Cantrill, thank you so much with PIMCO. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Newspapers, what do you have?
I want to start with Goldman Sachs because it's going to remove DEI criteria for its board members. This is an exclusive in the Wall Street Journal. So last year, you'll remember Goldman Sachs removed a requirement that companies have at least 2 diverse board members before advising that company on going public. So now this is taking it a step further. So it plans to remove diversity, equity, inclusion criteria from factors considered in identifying potential board members. It's going to be having a shareholder meeting in the spring, so it's doing this change now. And this was really at the request of the conservative activist nonprofit National Legal and Policy Center, which I didn't realize owns a small stake in Goldman Sachs. But they're not the first ones to do this. Citigroup, Bank of America did it as well.
It was a topic this weekend. What do you think, Paul? Was it like an era that's drifting away?
Yep. It seems like it.
After President Trump, does it just come right back? I don't know.
I don't know. I don't think so. I think DEI, for whatever reason, has had its time in the sun.
Next, what do you got?
All right, we're going to do a hard turn here and go to a New York Post story. Costco transforming the way you can now order your custom cakes, because Tom, I know you like to get your custom cakes from Costco, do you?
Yeah.
So customers are soon going to be able to place those cake and deli tray orders directly through the company's mobile app and website. How revolutionary is that? Because prior to this, you had to drive to Costco, take out your pen, and fill out a paper form in order to get your custom cake. So they're moving into the 21st century, and now you can actually make that order online with Costco.
Can you imagine Costco more digital? More like online savvy?
Yeah, sure.
It's amazing.
I mean, they should. They kind of have to. They didn't even say when this is going to happen. They just said later this year. And fans are already taking to social media. They're very excited about this.
Okay, very good. Let's look at the hot dog and Coke.
Okay.
And I like this story a lot. This is something I didn't know. So you learn something new every day with newspapers. In the New York Times, a story about how a President Trump tax break is helping breathe new life into horse racing. So look, horse racing, it's been plagued by cheating scandals, worries about animal safety, but the sport of kings seeing a bit of a renaissance here. Okay. Last year, owners spent about $1.5 billion on racehorses. That is up 21% from 2024. A big reason is a tax break tucked away in President Trump's one big beautiful bill. It's called a bonus depreciation. That means businesses can immediately deduct the full cost of certain assets like machinery and equipment to enhance their cash flow. So now it applies to racehorses.
Nice.
And it's helping turn these animals into a hot investment for wealthy people.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.